Dividends. They sound simple, right? But behind the numbers, things get tricky. SCHD, VIG, DGRO, they all promise dividend growth, yet each does it in a different way. Which one truly stands out? That's what we're going to break down today. Straight facts, side by side. And I'll warn you now, some of what you see might surprise you. For example, many investors say VIG is too boring to own. Is that true, or does boring actually win? Let's dig in. Before we start, one quick but important note. This is not financial advice. I'm only sharing facts and historical data. Past performance never guarantees future results. ETFs can go up, and they can also go down. Everyone's goals and risks are different, so always read the official fund documents. And if needed, talk to a licensed advisor. This video is here to inform, not to tell you what to buy. Chapter 1. What we're comparing and method. How I'll judge them. Now, here's what we're actually comparing. 3 dividend growth ETFs, SCHD from Schwab, VIG from Vanguard, and DGRO from iShares. Some people also bring up SPYI, so we'll mention it briefly as context. To judge them fairly, we'll look at their expense ratios, holdings, and sector tilts. We'll compare yield today, dividend growth, and past returns over 1, 5, and 10 years. And of course, risk. That way, we see the full picture, not just one headline number. Chapter 2. Snapshot. ETFs at a glance. Quick facts. Let's start with a quick snapshot. SCHD is the Schwab US Dividend Equity ETF. It launched in 2011. It tracks the Dow Jones US Dividend 100 Index. The fund holds just over 100 companies. Its expense ratio is 0.06%, and its current yield is higher than its peers, around 3.5% in the transcript example. Next, VIG. This is the Vanguard Dividend Appreciation ETF. It started earlier in 2006. It follows the S&P US Dividend Growers Index. It holds more than 300 companies. Its fee is even slightly lower at 0.05%. The yield, though, is lower. The transcript shows about 1.85%. And then DGRO, the iShares Core Dividend Growth ETF. It began in 2014. It tracks the Morningstar US Dividend Growth Index. Expense ratio around 0.08%. Yield is between SCHD and VIG. Chapter 3. Index and stock selection differences. Why the funds look different. Now, why do these funds look so different? It all comes down to the rules they follow. VIG has one very clear requirement. A company must have raised its dividend every single year for at least 10 years. That gives it a focus on long-term growers. Many of these companies are large, stable, and established. But the starting yield is lower because they reinvest more into growth. SCHD works differently. A company needs at least 10 years of paying dividends, but then it faces more tests. Free cash flow to debt, return on equity, dividend growth rate. These filters cut the list to about 100 names. The result is fewer holdings, but with higher quality screens, and usually a higher yield. DGRO has its own twist. It uses the Morningstar Dividend Growth Index. That index excludes companies that pay out too much. It aims for growth and sustainability at the same time. So DGRO sits in between. Chapter 4. Holdings and sector tilts. Let's open up the hood and see what's inside. SCHD holds around 100 companies. That's a fairly concentrated portfolio. The transcript numbers showed strong weights in consumer defensive at about 19.7%. Energy close to 19.4%, healthcare around 14%, and industrials near 11%. That mix gives SCHD a defensive and income-heavy tilt. Less tech, more steady sectors. VIG is the opposite. It holds more than 300 companies. That wider net spreads risk across more names. Its index favors dividend growers, so you'll find more technology and financial exposure here. Those sectors tend to drive price appreciation, but they can also swing harder in downturns. DGRO sits between the two, more diversified than SCHD, but not as broad as VIG. Its methodology filters out unsustainable payers, so it balances growth and stability. In short, SCHD feels concentrated, VIG feels diversified, and DGRO feels like a blend. Chapter 5. Costs, Liquidity, and Mechanics. Now, let's talk costs. SCHD charges an expense ratio of 0.06%. VIG is slightly cheaper at 0.05%, and DGRO is about 0.08%. These numbers sound tiny, but over the decades, they add up. All three ETFs are large and liquid. They trade with low spreads on major brokers. That makes them easy to buy and sell. As for distributions, each pays dividends quarterly. No tricks there. Liquidity and cost are not deal breakers here. But if you're holding for 30 years, even a fraction of a percent in fees can compound into thousands of dollars lost or saved. That's why it matters. Chapter 6. Historical Performance Snapshot. Facts only. Next, let's check how these funds have performed historically. Remember, this is past data. It does not predict the future. In the transcripts comparison, VIG outpaced SCHD in many long-term windows. For example, over a 10-year span, VIG showed about a 140% gain. SCHD in the same window was closer to 97%. That gap came mostly from VIG's larger exposure to technology and financials during strong growth years. But shorter windows tell a different story. In some one-year snapshots, SCHD lagged when defensive sectors and energy cooled off. Meanwhile, VIG caught the upside when growth stocks rebounded. On the flip side, during tough markets, SCHD's tilt toward defensive names often meant smaller drawdowns. DGRO's record sits between the two. It doesn't swing as much as SCHD, but it also doesn't capture as much tech upside as VIG. So historically, VIG often wins on total return in strong bull markets. SCHD defends better in downturns, and DGRO splits the difference. Chapter 7. Income Profile and Compounding Example. 30-year illustrations. Now, let's look at income. This is where things get interesting. According to the transcripts example, SCHD started with a yield around 3.5%. VIG started much lower, around 1.85%. But yield is only half the story. Dividend growth matters too. SCHD showed dividend growth over 11% in that model, VIG closer to 7.5%. So what happens if you reinvest everything for 30 years? The transcript ran a simple $100,000 model. After 30 years, SCHD grew to about 4.89 million. VIG ended at around 2.09 million. Of course, this is just an illustration. Results depend on assumptions. Market conditions change, but the lesson is clear. A higher starting yield plus faster dividend growth can supercharge compounding. That's why income-focused investors pay close attention here. And yes, this is also why some argue SCHD is the king of dividend ETFs. Chapter 8. Volatility, Drawdowns, and Risk-Adjusted View. Now, we can't just talk returns without risk. SCHD, with its tilt to consumer defensive and energy, usually shows lower volatility in downturns. That means smaller drawdowns when markets crash. But it also means less upside when growth stocks roar back. VIG, on the other hand, carries more tech and financials, so it can fall harder, but also recover faster in a rebound. DGRO, again, is the middle ground. The key point is this. Lower volatility does not automatically mean higher long-term returns. It just makes the ride smoother. Some investors value that more than the end number. Chapter 9. Practical Investor Decision Guide. So how can investors think about these funds in practice? If you want higher starting income and potentially stronger dividend growth, SCHD tilts that way. If you want a wide basket of dividend growers with a focus on stability and long-term appreciation, that's where VIG stands out. And if you prefer something in between, DGRO balances the two approaches. Some investors even mix them. For example, using SCHD as an income sleeve and VIG as a growth sleeve. But allocation depends on personal goals, time horizon, and risk tolerance. The bottom line is simple. Each fund has a role. The choice depends less on which is best and more on what fits your strategy. So let's wrap this up. We saw SCHD focus on income and compounding. VIG focuses on broad dividend growers and appreciation. DGRO standing somewhere in between them. Each with its own strengths, each with its own trade-offs. If you found this useful, drop a comment. Tell me which fund you prefer and why. I expect some heated debate here. And yes, boring VIG might surprise a lot of people. For full details, always check the official fund fact sheets. Thanks for watching. See you next time.